thank you very much for including me in this distinguished panel. Again, some of the issues I'm going to discuss today is related but complement what has been said. It's not a forecasting problem here, but nevertheless, it involves forecast of a counterfactual nature. The paper is being revised, and I send an updated version, which is, I understand Ali has updated on the web page. But this version of presentation based on what we did back in May, April of last year. I decided not to change anything because the question I'm asking is what would have happened if we didn't have any knowledge of what was going to happen, but we were at the end of 2019. So another acknowledgement very quickly that this is, as you see, a joint work with a number of other co-authors, Alexander Chudik, Kamil Mahaddes, Mehdi Reisi, and Alessandro Rebucci. Okay, so many of these issues by now are very familiar, so I would gloss over them. What we wanted to find out at the time, what is the effect of a COVID shock, and how would you identify such effect from empirical historical data, which was clear there is no evidence of that in the data in the past, is a very different shock than other financial or supply shocks that we have experienced over the last 40 years that we have data, quarterly data across many countries. We also know that there are global dimension to the shock, and this global dimension works both because COVID happens globally and transfers from one country to another, so they would have economic spillover effects. So you needed to separate the global effect from the, if you like, spillover effects, which, well, for example, Sweden is a good example of spillover effects, even if to separate the global from the spillover effect. So that was another issue. The third is a high dimensional problem, because obviously you need to look at the world at large, not just one country. It's not enough just to look at one country, and it's quite clear from the analysis that's really important to model interconnections. And also because this is a shock which is both unprecedented in terms of size and duration, so there may be nonlinear effects that we wanted to know whether that should be taken into account or not. So what is our contribution is basically to try to find a new method to handle unique events, which there is no historical precedent, and that's global. So therefore you cannot use the panel techniques, which is developed by Chen Chao, and also the synthetic control techniques or difference in difference techniques, which have been used nowadays regularly in micro policy evaluation analysis and some country studies as well. Like Chen Chao looked at what happens if Hong Kong hadn't joined China at the date, and then all Abadi looks at a particular region in Spain, and so on. So that really none of those methods, as you will see, can be used because there are no control groups as such to analyze. The second was the size of the shock. So we knew the shock is important and sizable, but we don't know how to actually calculate the size. So what we thought, we said, well, as David said in his talk, that nobody, the end of, towards the end of 2019, could have anticipated such a shock, and leave alone calculate its economic implications. So what we did, we said, okay, suppose IMF was in the same position, and they forecast for the year 2020, but their forecast was basically in January 2020, which was based on data in 2019. And then we looked at how they revised that forecast in April, because they saw the evidence of the COVID across many countries in Europe, as well as emerging economies and US. So they revised the forecast downward. So we said, okay, if we assume, which is an assumption, that IMF forecasts were sort of unbiased, although it doesn't mean they are accurate, they are generally unbiased, then we could say the revision of the forecast could give us some indication of the size. As to realize what other people have done, like Serena Neg and their paper, they basically guess a multiple of a standard error of output shock in the US. They don't even have a global interconnection of that. So therefore, what we're really doing, we're going to say the best guess would be the revision in the forecast IMF could be an indication of the size. But notice here that this revision is only the really forecast output growth, but we wanted also to look at interconnection of variable in the world economy through equity market, global volatility of the stock markets, long-term interest rates, and exchange rates. So therefore, we also needed to condition, use our model to find out the conditional, if you like, forecast errors, if the forecast revision of IMF was correct. So therefore, we then calculate basically, as you see, the revision of all the variables in the model based on IMF revision forecast. Then we identify nonlinear effects, which become important, and I'll talk about that. And then we develop a GVAR model version, which includes the threshold effects to deal with nonlinear effect, and then use our measure of IMF forecast revision to identify the COVID shock, which is to be separate from usual idiosyncratic shock happens to countries and the spillover effect of those shocks, as well as global shocks, which could happen in general anyway. And then we carry out some counterfactual analysis. And then we obviously, we can see how, we know the outturn in the revision of the paper. We also show what the outturns are and how they differ from what we did. You could use that further analysis to find out what is the effect of policy, fiscal policy, support economic policy, lockdown across countries, but we are not doing it in this paper. We have another paper which we look at it for the Euro to link the policy to the outcomes. Okay, so threshold effect, this is not new to this group. I mean, many people have looked at the effect of threshold in autoregressive models. Tong was one of the first, and his book is still a classic. And then it has been extended by, say, into multivariate context, but they are very simple univariate, but it's multivariate, but they are a very simple model, as you see, if you look at the paper. And Hanson gives a nice review of the development of Tong. My experience has been these models don't really do very well in forecasting because these are rare events, and it's very difficult to identify rare events and predict when a rare event happens. But I think for the analysis of COVID shock, I thought that important to allow for it because we know it's happened. We know rare event has happened, so it's no point ignoring that it has happened. Okay, so how do we then define the threshold? This is based on another work I've done, which came out, I mentioned that a bit later, which came out recently in a finance journal. So what we realized that you can calculate some measure of volatility, although it's not the same as uncertainty, but this goes a long way to correlate well with it. And we have daily data on equity prices across many countries in the world. So we use daily data, which is tau means a day in this equation too. And then you average basically a square of the, the return minus its mean. The mean usually is small, but it's nevertheless, we do allow for it. And then you basically calculate the realized volatility, which people have used with intraday data, like Neil Shepard and many others, and Frank Diebold have used it successfully to measure within the day volatility. Here, we are using it to calculate within the quarter volatility. And I think this is probably more accurate than realized volatility within the day because there are no macro, if you like, finance problem that there's a sudden jumps in the data. And is much less likely. And also we have number of days you have within a quarter is quite much larger than number of 10 minutes data you have during the day. So it's a pretty accurate, and you could rely on the fact that daily data is serially uncorrelated. So therefore, that gives you really very good measure. I recommend it. Try it, see what happens. So then what we do, then we use each country realized volatility, which is equation 2, where then you aggregate it cross-sectionally using PPP GDP weights to allow for different size of countries. And then that equation 1 gives us the global measure of realized volatility. So what we do then, we say, okay, when there is a rare event, we know that this global measure of volatility spike, as it did in various financial crises, and most likely, obviously we knew by April when we were doing the study that's already spiked because of the COVID as well. So basically what we do, we say how important is this threshold in the sense that when this global realized volatility goes above a parameter gamma threshold, which we do estimate by grid search using panel analysis. First we just but a simple model, let's take a growth rate model across 33 countries, advanced as well as emerging. Then we just plugged in a simple threshold variable, and this threshold variable is very straightforward. Is the indicator variable, which is basically when the threshold is breached with the value gamma. And then we do estimate gamma. Obviously, we can't do it for each country separately. So we do panel data method, and we estimate gamma, but we estimate it separately for advanced economies and emerging economies for obvious reasons. So we have enough data to do that. And then I'm going to share you with the results here. These are the advanced economies. So we find that basically the threshold value is 0.156, and that means 3%. So this is pi, actually, not rho. Sorry about the typo. Yeah. So basically, this 3% means that if the probability of such an event happen is 3% for the advanced economies. What's interesting that we find the coefficient of the threshold is everywhere negative. And basically, if you notice here, and this means this double dagger means 1% significant, and so on. And then the star means 5%, 10%, and one dagger means at 5%. So you see, it's highly significant. Quite a number of them, 80% of the countries in the advanced economies show this threshold effect to be highly significant. And then if you look at the average of it, you'll see that's the case. If you look at the growth persistent, as probably most of you know, is only in the US and UK, they're highly persistent. Many countries, the percent lower. So therefore, this contributes quite a lot when such an event happens. Of course, most of the time it doesn't happen. We know that. So that's important to bear that in mind. So what we did the same for advanced economies. We find there is a less important in advanced economies. I think it's not surprising. We did explain that in the paper. I don't want to spend too much time on it. It's not the focus of our work. But in advanced economies, in emerging economies, there are other factors, the more local factors could be at work. The capital markets are not as developed. So therefore, there may not be shocks, may not have the same effect as they have on advanced economies, because much more correlated, and much more integrated with the capital and money markets. But nevertheless, still, if you look at this data, we get some positive, but they are not significant. So the event is always a negative effect on growth. So it's not therefore surprising every time we have huge volatility rises, you get this output drops more than usual. I'm not saying you can predict it because it's very rare. In the case of emerging, the number was 5%, 5% of the time. So this is basically showing that excess volatility, what we call it excess volatility, become important. This paper, which came out in recently Review of Financial Studies, we show that actually this measure is also important if you want to look at asset returns and then the way it relates across the world economy. So obviously, normal conditions, we don't have this additional negative effects. So we knew that we had this negative effect, the volatility as a spike, so that we wanted to know what would happen if we use this in the model to analyze the effect of the COVID shock. Okay, this is just to summarize what I just said. I think it's just basically explaining the result which I've already alluded to. If you look at the relationship of this and output growth, you see this is the 2008 financial crisis. You see definitely there is a dip in output growth. That's red is the world output growth, and here is the US. Really, they are highly correlated with each other. And if you look at US is more volatile than world output growth. So we prefer using world output growth is more a measure of diversified measure rather than US. Some people have used. But nevertheless, they are quite related, especially when there is big spike happen, you find that there are some dips in there. There may be one lag in there, sometimes it's not as good as 2008, but there is obviously a correlation at the global level as well. So now we go to the incorporating the threshold effect into the global model, but we also have to adjust the global GVAR model, which I and my other colleagues have developed to account for the fact that we have global shocks as well as spillover local effects. I explain how we did that. Okay, so why did we use the global model? Well, because when I say global, I mean many countries, but they are related. So this is not one model of a global economy. Probably I should clarify. So we have, as we see, we have 33 models are interlinked together, which then there may be a global factor which affects all of the 33 countries. And then could be also obvious, local effect, which is clearly present, say, in Europe and in between Canada and the US and Mexico, for example, in Latin America and in Southeast Asia for sure. So basically, you need to somehow model that. So the way we do it, we use we develop global factors, and then we also allow for a cross-sectional measure, which are trade weighted, which then picks up the local measure. When I developed this model, the first time IMF said, why don't you use other weights? I said, okay, trade weights are available, they are reliable, and we obviously make a 3-year moving average of trade weights, so they show sudden jerks. And because the world economy is highly correlated, the results are not that sensitive to the weights you use. But I think everybody agrees now that trade weights are pretty good measures to use, and we can only use lag values of trade weights, so therefore they are predetermined. There is no simultaneity issues involved. Okay, so what do we do? We take the world economy composed of n+1 interconnected countries. US we denote by 0 as a numeric country, numeric currency country, and then the rest of the words are denoted by I from 1 to n. N in our model is 32, so it would be with US would be 33. For each economy, we focus on 4 variables. Explain why we did not include other variables like GDP. Obviously, that's what the focus is. We include long-term interest rate because a lot of studies show that the curvature of the yield curve very important for growth. And we also use we didn't use short-term interest rate because it didn't have much movement, and we decided that equity prices and log of the real exchange rate, which is basically the nominal exchange rate divided by the CPI, is not what people usually define as real exchange rate, but I think it's a nicer way of defining it rather than bringing in the foreign prices as well. That stabilizes, for example, when you look at Latin America with that hyperinflation, the E and the P in the model just gigantically grows at the dramatic rates, but E divided by P is similar across all over the world. So therefore, that allows us to combine countries with very, very different inflation experiences. And so the period is this data we have from 1979, Q2. So we already got something like 160 data points, which is pretty good for this kind of model estimation. So for each country, we have at most 4 variables. Why I say at most? Because some countries, there is no equity markets, and some countries, many countries don't have long-term interest rates. China doesn't have a long-term interest rate. India doesn't have a long-term interest rate. That's the main problem actually in world economy. There is no long-term interest rate except for US really and a few other ones. So what is the variables of the model? So each of them could have at most 4, but because it could vary, we call them Ki. So some Ki's are 4, some Ki's are 3, some Ki's are 2. But that's not a problem. The total number of variables in the model is the sum of the Ki's, which is, in fact, would be 109 variables in the model. And then we have 161 quarters, I've already said. If you want to just model the Y, like a lasso or some other regularization black box techniques, I think you're welcome to it. It's very difficult how you do counterfactual analysis with this kind of model. And I'm not sure that they would be the best way to go forecasting even, but I'm not going to be commenting on that. But nevertheless, people are doing it. Usually, often they take one variable at a time. But here, there are much more connections. Okay, so it's in a way, TG bar also address what you may call high dimensional problem that many people seem to be moving towards without thinking sometimes, but that's their problem, not mine. So what we do high dimensional, but we put some structure on it, but not a straitjacket, which DSGE, I call it a straitjacket. So I'm somewhere in between a pure time series modelers and DSGE modelers. So I hope it serves a purpose as being intermediate between these two extremes. So what are the global factors? Well, we already know that the global realized volatility is a global factor. So that's one measure. We also include oil price changes and another measure because that in the past has been important and actually could play an important role even recently. See what happened to oil prices over the last 3-4 months. So what are the basically other global factors we have? We use output world output growth, which is a global factor, world interest rate, long-term interest rate, global factor, world equity returns, and world exchange rate. These are weighted averages, all PPP-GPD weight. So basically, we have 6 global factors. So these are 5, 2 here, and 6 here. These are different in some way because they are measured different aspects of the world economy, but these are internal to the model. And that's like basically using principal component. If you take the first principal component of all the 33 GDP growth, you get more or less the same as the cross-section average. I like a cross-section average because the weights are meaningful and they don't vary, they are not random. So it reduces random variation. And I've shown in a number of studies that that works better rather than using principal components. Even if you use principal component, by the way, you may be tempted to use principal component, all of them together. That would be really bad. At least if you want to do principal component, use principal component of different categories separately rather than put them all together and blindly calculate principal component. And then ask yourself, how many are there? Now, then what we need to do, we need now to link all these global variables to the original Y variables because they are a function of the original data. So Y, remember, is a vector of 106 variables in the global economy. And then W basically is implicit weights, which come from this this is the PPP-GDP weights, comes here. So this matrix of the PPP-GDP weights for the whole of the world. And then you map it, and then that gives you Y tilde. It's very straightforward. It's just a mapping. I call these matrices in honor of Larry Klein link matrices. So basically, then you can then calculate also local averages, which is based on trade weights. And this is how we usually do it. We use the trade, which is the sum of import and export of country I and a J between I and a J. And then we calculate the trade weights averaged over a number of years. We use here 2014, 2016 as a reasonable midpoint. So not midpoint, near where we are at the moment. It turns out, again, doesn't make much of a difference which weights we use as such. We do some sensitivity check. Okay, so what happens here now, we can also link all of the Y star. Remember, Y star is just simply given by these expressions here. These are Wij, so therefore, this become Wi. Now it's country specific. So therefore, the Y star of country I is a mapping from all of the values in the world into itself, but through the trade weights. We have a study which we allow for trade weights to vary when we want to look at the emergence of China or Latin America. That is not a pose a problem, but for this study, we thought it's not really needed to try to be sophisticated about trade weights more than what we have done. So basically, that then shows you how global factors relate to the underlying individual variable, how local factors, they're called Y star IT, relate to the individual variables. Then we can now have a model for these variables. The first thing, we model the global variables is just simply by a var. You only need a separate model for these global variables. And then we do model of each countries which incorporate the global variables. Remember, we add the G and the YT. Now F is the factor. Remember here, our F is observed, it's not principal component, it's not unobserved. We have already resolved the uncertainty estimation. Obviously, there is a shock, VT to global factors here. So then this is what we want to separate from the other shocks, which are idiosyncratic UIT. So we have the F here, and that's the model we use for the threshold autoregressive model for each country. So this is the VAR. This is the VAR, like a spatial or local effect. This is the global factors, and this is now the threshold effect. So we include all of this in the model. And then we can estimate the model country by country because these are lagged values. This is global factor is orthogonal to the U. We've shown that we can estimate them by least square, basically it's like a factor augmented bar, if you like to call it. But then we don't we estimate the factors using this setting that we have already set. Then we estimate the model. We put the model together. This is well known how you do it. You stack the model. You then go through different steps. Then you add up all the weight matrices together. You get this. Eventually, you get this bar. And then we also put factor back in. So therefore, we separate the shock to the factor from the factor history. So here are the historical part. These are history of the actual interconnection in the world economy, either through the global factors or through local factor effects. This is the global factor, which is now which is given in the history. This is again the threshold effect. Now we end up with two shocks. This is the global shock, and this is the idiosyncratic shock. Now, what we want to do, we want to add the COVID shock to it, which we haven't done. But let's just do that. You go through the steps. Then you get basically a gigantic model. Let's call it like a bar. Some people, instead of calling the G bar, which is a global bar, they call it gigantic bar, which is similar. So, however, we are not estimating this model directly. X is now composed of all the domestic variables in the world economy and the global factors. So we then model this. This is not a model. We have already estimates of them from individual country. We plug those estimates here, so we can now model this and simulate it or forecast with it if you want to. Now, what is E now is a composite shock. Remember, it's composed of the global shock and the idiosyncratic shock. The reason it's become epsilon because we pre-multiply the model by the basically you take it other side and you pre-multiply it to get reduced function because you have got the G here. And the G is estimated from all the individual country model. Okay, so now how do we now the promise of what we do with the COVID shock? Let's get to it now. Now, obviously, sorry, we also put in the threshold effect. We already explained it there. I don't want to go into that. We don't have the time. So let's just look at identifying COVID shock, which is the whole point of this paper. So to identify the COVID shock, obviously, we now need to go back and find out whether, because we have no history of it, so we need to go back and put it back in using the, if you like, the IMF revision of the forecast between when they didn't know COVID is going to happen and when they were aware that COVID has happened. Okay, so that's where we're going to do that. I've already explained that, so I don't want to go into that. So we are sitting at the end of 2019 quarter four. So the ET which is the errors before 2020, which is just till the end of 2004, is the same as without the COVID shock. So the COVID shock is omega. Okay, so this is the COVID shock. But without the COVID shock is this. But remember, these are all correlated between themselves, but E and V are uncorrelated. But the V itself is correlated and E is correlated because of the idiosyncratic shock are correlated between countries and even maybe weakly across countries. So what we do then, as we go to the future, which is quarter 1, 2, 3, 4, this would be 2020, we need to work out what this WTQ is to add it to the, if you like, the historical shocks. So this is what we do. We say, okay, to identify that, we look at the output growth in April, and then we look at the output growth in January. So the difference between these two is the revision. But remember, it's only for output growth. This is for country I in quarter 1. IMF produces for all of those 4 quarters. So we have data for Q1, Q2, Q3, Q4. So we have this from IMF. This data comes from IMF. We can obviously perturb this, but I thought it's best is just to keep it as what IMF come up with. Otherwise, they would have themselves would have changed it. So then what we do, we just put them on for across countries that become a vector of K, which we get from IMF. Now, that only gives us for output growth. It doesn't tell you about interest rate, exchange rate, and equity market. So what we do, we then, if you like, backcast, as it were, what would be the shock for other variables in the model, not just output growth, but for all the other models. So we use the correlation, historical correlation to do that. Now, first, what is S? Is basically S is like a 0-1 matrix with lots of 0-1, which basically picks up the GDP growth from all of the X's in the model. Remember, X in the model was all the global factors plus all of the individual country variables. So we can get that. So therefore, this is what we do. This is for the WT+1. So you just basically, this is the first one. So what is the DE? It's just like a regression mapping to give that. If there were only GDP in our model, S would be 1, and that would become 1 identity matrix. But because this is many other variables they're interacting, and then because we go forward in future, second quarter you get the effect of the VAR, G. Remember, G is the coefficient of the VAR. Third quarter we get G squared. Fourth quarter we get that. So we need to allow for that. So that way we can work out what is the, if you like, the COVID shock, which is we call omega now, for all the variables in the model, and across the periods 1, 2, 3, 4 quarters. Okay, so now we can work out what is the COVID effect. So the COVID effect is the difference between what would be the the variable in the world economy subject to the COVID. It's a counterfactual. After the COVID has hit the economy, in other words, when you added these variables added in, as compared to a baseline, which we have no shock, we just calculate the forecast. Remember, this T means 2019, the end of 2019. So everything is done at the end of 2019. The only difference is that we include these shocks in addition when we calculate the counterfactual part of X as compared to the baseline part of X. So this difference, we then can simulate and calculate this median, interquartile range, anything we want using the simulation techniques, which is quite a standard now to do that. Okay, so that is the basic idea. Now, the countries is all in here. The bracketed figure means how many variables are in each of these countries. For example, you see that some countries have 3 variables here, and they don't have long-term interest rate. US has 3 variables because the exchange rate is a numeraire. There is no exchange rate there. But some countries have got only 2 variables. Either like Saudi Arabia, there is no interest rate or no equity market price over the history. I mean, they may have some of them that have more recent data. I'm saying when I say they don't have the data, I mean from 1979 till now. Okay, so the countries, by the way, cover quite a wide range, and also we then group them into emerging economies, emerging Asia, Latin America, other emerging, we single out China and US and a few other European countries to see what happens to them. So I'm going now to the figures. Remember, these are not forecasts. It just says that if we use the IMF judgment about the effect of the size of the shock of the COVID, what would have been the shortfall relative to the baseline? Remember, forecast, the baseline is not a forecast. The baseline is, again, another counterfactual saying if we use the model without any shock. And that's, I think, the right way to look at it, rather than looking at the outturn. We look at the outturn, but that's a different exercise. So obviously, there's quite a lot of uncertainty across these forecasts. We see that because of the financial market volatilities, policy actions, and so on and so forth. And also, we'll see that just look at the picture first. So this is to do with the world. So basically, you can see a dip here, quite significant in the second quarter, which actually more or less happened. This is a little bit more exaggerated. You see when we look at the outturn, which we have added to the paper. I will show you later. But if you look at here, because of the way that China handled it, China wasn't much affected by it. Obviously, the draconian measure they took, many countries in the world possibly couldn't do, but they managed to do it. And still, they are subject to problems because they haven't the problem not solved there. As soon as they open up the economy, that problem will show up again. So it's not the end of the story there, in my view. But if you look at it, that because of China and some other emerging economies, which they did better, like in Vietnam or Taiwan and so on, advanced economies, the result we saw that would be much worse for advanced economies than for the other countries in the world. And Europe was in particular worse hit, according to our counterfactual analysis, would have been worse hit than the other advanced economies. US was less hit. UK and Europe was very similarly hit in this from the shock. But then it's recovering relative baseline. But the UK seems suggesting that it may be, I'm not saying this is a forecast again, it said that it may be below the baseline. So it would be more hit, maybe because of other factors, which was affecting the UK model. So if you look at the US, again, these are without vaccine, without knowing what policy people use. This is just sitting and asking yourself, if I don't do anything and compare it with baseline, what would have happened? Okay, which is seems to be reasonable in many ways. Again, it just captures the difference in China and Southeast Asia and the rest of the world. Okay, so what is by the way, in the paper, we also have the effect on long-term interest rate and so on. But I thought, given the time we have, and we want to finish on time and maybe have some discussion, so I'm not really going over, and it's late for everybody. I'm the last speaker. You guys in Europe should be having your dinner, really not listening to me. In any case, so what we see here that we can basically formalize there's different effects, like external shocks as opposed to the spillover effects. And we use this in the case of Sweden. It was mentioned that Sweden take a different tack. And the question was, the issue wasn't for us whether the Swedish model originally, although there is no Swedish model as such nowadays, but I mean, it was the difference between Sweden and the other countries in Europe in early 2020. Would it have helped them economically? That was the question. Not that they reduced the number of death or the cases. The question was whether they could have less economic impact. The problem is that we saw that they wouldn't, because Swedish economy is related to the rest of the world and Europe. 70-80% of the trade of Sweden happens with in the countries around them, either directly or indirectly in Europe. So therefore, what it says that, in fact, if you looked at the Swedish economy and included the Sweden in the model, or excluded the Sweden, the effect on Sweden wouldn't be that much different. In other words, the way we think about it, suppose Swedish economy was included, they were subject to the shock. Remember, this is not about lockdown, it's about the shock, which IMF shock, basically. So it turns out that it was very difficult for Sweden to escape from the economic consequences, even if they followed a different policy of isolation. When you're so much dependent on the rest of the world and your economies are interrelated, you will go down partly with the rest of the world. You can only safeguard yourself just by a very small amount. And that's what we saw in the data. So you can't go by yourself in the interconnected world. To summarize, these figures basically show that obviously we saw that the COVID shock could be quite sizable, it persistent, and if you don't do anything about it, there was no new policies and so on, which obviously clearly important policies were put in place, and vaccination obviously was the key, which came online. But then you could look at these differences, and as I said, we have another study, we look at this and find out to what extent these other policies have been important in this area. So these are to do with the output, not relative to the baseline output, rather than baseline counterfactual. You find that, again, China, we predict without, obviously we already know it has happened, recover to the levels they were before. Here is more pessimistic. Without the vaccination and so on, this model would predict that US even wouldn't catch up even by the end of 2021, but it's more likely that it will do. But there is a margin of uncertainty, as you see, we are already in here. Europe was more hit by comparison, and the United Kingdom similarly. Whether they could recover without some new policies or help with the vaccine is very unlikely. So hopefully with the vaccine and new policy, they would be able to recover back to the trend they had after the end of 2021. But it's still early to predict that. And that is for all of the advanced economies. The world economy, the model was much more optimistic that it would recover back to it, I guess, due to China and other emerging economies. But the advanced economies are very similarly placed, although there are differences as we looked at UK and US as compared with others. This is if you without or with including China and so on. It's a similar pictures here. And if you look at the median that we saw Q4 over 4 of 2020, you find these numbers actually quite reasonable. I mean, the US fell by 3%. I don't know what the data is for Europe in my mind, but these are not that. If you got UK fell even more. So these are, I'm not suggesting we are forecasting, but if you want to do that, that's it. And then the model predicts all of them is going to have a positive growth, although this is too far ahead for the model to have any predictive value, given it doesn't include all these other factors, vaccination and other measures of lockdown in the model. So there are considerable uncertainties. Just to summarize and finish here, basically our contractual result, remember, was done in April of last year. Nobody knew what was going to happen to the world in terms of any of this, what we have already known by now. We knew China was much more effective, but it wasn't clear China could hold it, but they did hold so far. And then we'll see that the major differences across countries is to do with the policy that affected or the way their economy was dependent on the rest of the world. And we also find that because of spillover effects, our finding underscored this importance of spillover effects and global factors, which we showcased this by showing that the case of Sweden, that we had less stringent approach towards the pandemic, but they had very similar experience as many other countries around them. I'm going to leave it at that. I wanted to finish a bit earlier as the time is it's too late for many of you. So if there is any question, I'm happy to respond, and I'm also happy to show you the results if you include policy variables in the model. Not in this model, in a related model.